Welcome to Thornburg Investment Management's 2023 Outlook Webcast. My name is Mike Ordonez, and I'm the Director of Client Portfolio Management here at Thornburg. Today we're going to discuss how to navigate the investment waters of 2023 following what has been a very volatile year. Persistently high inflation, a hawkish Fed, ongoing geopolitical risks, and the continued risk of recession have dominated the headlines, and we will set the stage on those topics and hopefully more. A few housekeeping items before we get started. At this time, all participants are in listen-only mode. However, you can ask questions at any time by submitting them directly through the WebEx portal or emailing us at questions@thornburg.com. That's questions@thornburg.com. Just to remind you, the webcast is being recorded and a replay is going to be available in the next few days. For those on the call today who may be less familiar with Thornburg, we are an investment management firm based out of Santa Fe, New Mexico, overseeing approximately $40 billion of assets across a suite of actively managed equity, fixed income, and multi-asset solutions. I'm thrilled today to be joined with my colleagues, Ben Kirby and Jeff Klingelhofer, co-heads of investments for Thornburg. In addition, Ben and Jeff are portfolio managers on some of our most popular investment solutions here at Thornburg, and there's obviously lots to discuss. So guys, thank you very much for having the time today.
Thanks.
Let's get into the topic of the webcast, which is a return to normal, and really talk about how your experience in 2022 is informing your position for this year. Jeff, maybe why don't we start with that and how 2022 went?
Sure. I mean, I think you mentioned a lot of the things in 2022, right? To me, 2022 was much less about the discrete time period. Yes, it's the last year. But really, the question today is whether it is the exit of what has been a decade and a half of one of the greatest social experiments in human history, right? It's not just the economic implications, the extreme support of not only markets, but extraordinarily accommodative monetary policy and very, very easy fiscal policy. But the implications that it has on the socioeconomic aspects that we're seeing today, right, around labor and economic labor market conditions in particular. As we look forward, right, what we are leaving potentially in the rearview mirror is the question of whether inflation is or is not transitory. To me, transitory was never a definite timeline, right? It certainly exceeded the time expectations of central banks around the world and investors around the world. But what we are seeing today is many of the non-structural aspects of inflation begin to come down. A lot of the supply side constraints are easing, and we're seeing goods inflation fall. And as we look forward into 2023, the most important question that investors need to be able to answer and opine on to build portfolios successfully is where inflation heads from here. What we're also seeing is a lot of the structural impediments, significantly tight labor markets, prop up inflation. And as we look forward, one of the ways that I'm thinking about that within the context of portfolios and its implications is, right, the correlations of equities versus fixed income, the starting plates of both of those asset classes that will have profound implications for asset allocators and money in motion into 2023.
I'd love to touch on correlations, but Ben, maybe before we go there, 2022 was the hardest year since the global financial crisis in 2008. Jeff has just talked about cheap money. In your markets, what are you seeing that 2023 is going to help? That 2022 is going to help you understand what's going on in 2023.
Sure, thanks, Michael. So I think that COVID created an unusual business cycle, right? So we had an unusual slowdown, then an unusual bounce back, and now we're having maybe a more normal business cycle with a more normal Fed tightening and a slowdown economically. Certainly 2022 was an unusually bad year from a multi-asset standpoint. Equities down almost 20%, but the multi-asset portfolio on a 60-40 basis was down as much as it was going back to the 1930s. So stocks have gone over the last year from being overvalued, kind of in the top 1% of overvaluation, to fairly valued. And I think bonds have gone from being overvalued to maybe even attractively valued today. So the setup as we look to 2023, certainly from a valuation standpoint and from already having a lot of the wood chopped from a monetary standpoint, is certainly a better place than we were 1 year ago.
Well, you guys both touched on it, so let's go right there, and that's the 60-40 portfolio and the correlations really of bonds and equities. Do you think that this year, obviously last year, a stagflationary environment creates a perfect environment where you have seen bonds and equities move in the same direction? Do you think that's the base case for this year, or hopefully will we see some alleviation, at least in one market?
You know, starting place matters a lot, and I already touched a little bit on just inflation being the central tendency, the central question that we have to answer as investors, right? And so really the question that immediately I come to in trying to answer where correlations between fixed income and equity go is where does inflation go? And really you have kind of two base case or two potential outcomes. Right. My base case is we're past peak inflation, but that doesn't mean we're going back to normal. It doesn't mean we're going back to 2%. There are significant structural impediments from the inflationary backdrop, wages and services being the primary ones, which suggests to me that the Fed will likely be on pause much longer than the market currently expects. But the starting place within fixed income is notably better, right? Central banks gave us no alternative other than to chase risk assets. The starting place of U.S. Treasuries, let alone global treasuries, right, or global risk-free assets, at near zero levels, the correlation was almost certainly going to be positive as we experience into 2022. As we look to 2023, the 10-year Treasury sitting mid-threes, all of a sudden, if we head into a deep recession, I do expect that fixed income shields portfolios relative to equities. But on a base case, right, if inflation remains relatively high, I think you can expect roughly a kind of a coupon year within inflation, and potentially some positive returns within the equity side.
And your thoughts on correlations?
Yeah, so the risk-free rate is the foundation for equity valuations. So when the risk-free rate goes up, all else equal, equity valuations need to come down. What's interesting today, as Jeff pointed out, is that bonds have interesting yields, and so they offer equities a bit of a run for their money in many cases, right? So high yield bonds yielding 9%, that's competitive with the long-term return of stocks. And of course, the risk-free rates, also an interesting level, higher than the dividend yield on equity. So that's a significant change versus 1 year ago. I agree, the possibility of inverse correlations is higher this year than it was last year, and we should all welcome that. As investors, we want diversification, we want assets to go in different directions, and give us an ability to have a more all-weather performance in our overall portfolios.
Great. Jeff, you've touched on it now, but central to everybody's mind for 2023 is the inflation picture. Obviously, we're nowhere near central bank targets of 2%, and hopefully what we've seen at the end of 2022 and the beginning of this year is some alleviation of that pressure. But curious as your thoughts on where we stand with inflation today and how we end the year.
I mean, looking forward, to me, it's pretty clear. Inflation is not now on a downward trajectory. The question becomes, much as when it was on an upward trajectory, where does it peak? Today, the question is, where does it trough? And I believe that markets are still focusing and believing that we're going back to the world of normal, 2% or maybe even slightly under. And I don't think we're going back there. But I would also ask, maybe the flip side of the question is, do we have to, right? What is normal inflation? And my argument would be is that not all inflation is created equal, right? Goods inflation is particularly distortionary. It makes it incredibly hard for me and you and companies to plan. But services inflation on the other side, right, has the potential to lift up purchasing power, can be much broader in nature and ultimately positive from the perspective of a central bank. And so as I look forward, I think much of the supply side constraints are easing. We're going to continue to see goods inflation come down. We'll probably enter an era of 3 to 4% sustained inflation, but that still above target inflation will be driven by services inflation. So I think we're getting closer to normal, but I wouldn't expect a complete reversion to normal. And as a result, I think central banks are, again, they're likely to stay on hold much longer than the market expects.
Ben, do you agree with that? Could see hopefully some alleviation this year?
Yeah, I think inflation has come in kind of four waves. You had the COVID supply chain constraints, you've had a lot of money printing, then you had the Russian invasion. So those are kind of the three aspects of inflation that I think are a bit more transitory and can come back. The fourth aspect that Jeff is talking about is a very tight labor market, and unemployment at 3.5%, wages still growing, labor force participation is down over this time period. A lot of people chose to retire early in COVID, and there's also lower participation among working age people as well. So the labor market is tight. That part of inflation can be a lot more structural, whereas the other three are all kind of pulling back at this point.
Okay, that's interesting. So, okay, why don't we move over to probably one of the worst kept secrets of all analysts on Wall Street is really recession expectations for 2023. You hear the IMF speaking last week, certainly very strongly at how the recession probability, because of the three big economies, European Union, the US, and China, all slowing down simultaneously. It seems to be more than consensus that we are going to be in a recession at this point, at some point this year. Maybe Ben, I'll start with you. What do you think about that idea? And yeah, when everybody believes one thing, is that an opportunity for investors?
It's absolutely consensus. It's unbelievable. I think that people expect a global recession, maybe in Q2, but certainly by Q3. And it'll probably last a couple quarters. So that's very uniform. What that means for risk assets is expectations that we're going to have a bad first half and a good second half, right? And that we're going to end in 2023 about where we are right now, maybe up a little bit. So that's the path that it feels like 85% of people expect. My expectation is that's certainly a reasonable possibility, but the base case is probably that we don't end the S&P at 4,000. It's probably that we end higher probability at 4,500 or 3,500 because the current expectation is kind of averaging a few extreme events. So 4,500, what would that be? That would be a soft landing and earnings continue to grow. We look out to 2024, earnings are 250. You know, that's a very justifiable level over time. Similarly, on the other side, if we have a harder landing and inflation is harder to tame, then we're going to have a worse outcome for the economy and for risk assets.
Jeff, what are your thoughts? One third of the expectation that 1/3 of the economy is going to be in slowdown. What are your thoughts on recession?
Look, I think it's undeniable. We're slowing down. That to me, that's not a question. The question is whether you dip into outright negative GDP prints, right? And we already have, to be fair. But we have to keep in mind, we're slowing down from an incredibly strong point, right? So the US economy in particular is driven by the US consumer. And the US consumer has had the lowest default delinquency ratios pretty much in the entirety of economic history. So the starting place is just phenomenally strong. Are we slowing? Yes. Does that mean that we must dip into a recession? Not necessarily, but we're keeping a very close eye on a number of metrics, and particularly consumers today, especially in the lower income cohorts, have already spent through all of their COVID stimulus. They're saving it in order to continue to work with their purchasing habits, right? And so I do believe that we're likely to head into a mild recession, but again, it's base case. So the market's probably already priced much of that. Really, from a probability standpoint, we need to think about the two scenarios that Ben mentioned, right? Either the notably prolonged recovery or a deeper recession. And right now, one of the fears that we're watching is just the market is pricing for base case probably pretty well, but it is mispricing for the higher probability that the slowdown ends up in an outright deeper recession than we expect.
Okay. So to that point, I mean, really, the early 2022, the Fed really was the major factor in getting us into this bear market. And that's probably one of the more important questions hanging over investors' minds is how does central bank, how does everything we've talked about right now infer central bank policy? Maybe Ben, you want to start with that, and then we'll go to Jeff. Maybe focus on the Fed.
So the Fed is definitely hiking aggressively into a slowdown, and that's not common in history. So I think we're all worried that they're going to hike too much, and they're going to tip us into more of a recession than is necessary. So I think what the market would love to see is for the Fed to slow down and for the Fed to sort of let the long and variable aspects of monetary policy play out, and let's see how all of the tightening affects the real economy for a few quarters, and then we can reassess. The risk is that the Fed has been embarrassed, right? So the Fed was really wrong last year, really wrong the previous year, and they stayed loose for way too long. So the risk is that they're embarrassed and that they have gone from 3 mandates to focusing on 1 mandate, and that's inflation. So I think the market is fairly unified that we'd like to see that pause. We're not clear if the Fed is going to do what they say, which is remain very hawkish.
Jeff?
Look, I agree. It's a very difficult conundrum that the Fed has found itself in. But just pursuant to your opening question, a return to normalcy, right? We have to remind ourselves that the last decade and a half wasn't normal. We stimulated economies around the globe with extraordinary monetary and fiscal stimulus, and yet we got no inflation out of it. Every economic textbook I've ever read says that's not the likely outcome. And so we aren't necessarily exiting today into normal. The question is whether we're exiting from a very non-normal environment. And that non-normal environment would be Fed funds rate notably higher than where it has been over the last decade. So what is most apparent to me is when you listen to central bank speeches, they are telling you they're playing for a downturn. They believe too that one is coming. It's consensus inside the Fed, and they don't care. That's what they need to see. And so the only way that I think that they're likely to be in motion with cutting rates is a very, very deep recession where inflation really does fall off a cliff. I think there's actually still a significant risk that maybe inflation is still, right, it's off its peak, but if we hang out with inflation at 6, 7% or even 5%, that's likely to cause the Fed to double down on its inflation fight. They can't risk having ingrained, sustained high inflation as consumer expectations. And so if anything, I think the risk is actually tilted to the other side, that inflation doesn't come down nearly as fast as we expect, and central banks, after a short pause, end up having to hike again.
Well, let's come back to that. That's interesting to think about what that rate path looks like if that's the case. Let's talk about fixed income. I'm going to read you something. Since 1976, the broader bond market, measured by the AG, is been negative 4 times. 3 of the years where we were actually negative, 1994, 99, and 2021, the return was in the 2 to negative 3% range. In 2022, the AG was down 13%. So how much further does the Fed need to go? And what clues should we get about Fed pivoting?
I think in answering that question, we have to rewind the clock all the way back to the 80s, right? We've been on a one-way train lower in yields broadly within fixed income. And that has led to, I think, base case return expectations that they were unsustainable from the start. And so we had a great reset in 2022. And now, of course, the question is it over or do we continue resetting? And what I would look for in a pivot in particular is it all comes down to labor market conditions. As Ben talked about, the Fed actually has 3 mandates. We don't talk about that third one, but it's incredibly, incredibly important. We always talk about inflation, right? Price stability. We always talk about maximum employment. We never talk about the third mandate, which I believe is a little bit of a social stability mandate. Technically, it's moderate long-term interest rates. But as I'm looking at where the Fed may pivot, it all comes down to inflation has to be contained. At this point, I think we actually already meet that. Inflation is contained. It's just contained at too high of a level. So the third mandate, right, around social stability perhaps, intersects very well with labor market conditions and whether the Fed is compressing the wage gap. So my belief, what we really need to focus on in looking for a Fed pivot is getting inflation down to probably 3 to 4%, and where that non-return to normal, lacking of going to 2%, is remaining relatively strong from the services side, continuing to see wages compress. So to me, all eyes have to be on the labor market.
Maybe just one more follow-up on fixed income. You see a better chance of the 10-year going lower than 3% than resuming its march upward?
No, I don't. Our base case expectation is the fair value of the U.S. Treasury today is kind of in the upper 3 to very low 4. Right? To me, that's a very sustainable level. I still remain hopeful that we avoid an outright deep recession. And without that deep recession, I don't see how we get a 10-year Treasury down at 3%. I could absolutely see a case where it marches higher from where it is today. We also have to keep in mind the rate volatility over 2022 has just been extraordinary. And so 10, 15 basis point moves are kind of a common daily occurrence. And that should not be a common daily occurrence.
I don't want to get you too existential, but as a fixed income portfolio manager, what role does fixed income play in 2023 in a client's portfolio?
I think it plays the classic definition of fixed income, right? It has the ability to provide negative correlation with other risk assets, aka equities. The income component of fixed income today is tremendously interesting, right? Core portfolios are easily kicking off 5 or 6% yields. That to me is a very good setup. Additionally, and most importantly, I think what a lot of asset allocators learned throughout 2022 is fixed income didn't serve that negative correlation. And really that was a challenge, and very few fixed income, probably no fixed income portfolios are truly able to overcome that. But there's a bifurcation between the ones that were reach for yield at all cases, right, that really had a challenging 2023. So we need to remind ourselves that when you're allocating to fixed income, it should behave like fixed income. It should have a defensive nature, right? So despite the fact that portfolios weren't up this year, ideally good fixed income managers were down a whole heck of a lot less than ag and a whole heck of a lot less than their competitors.
Thanks, Jeff. Ben, let's go to equities, spend some time there. If you think about the MSCI ACWI, or All Country World Index, losing about a fifth of its value in 2022, that's about an $18 trillion rout. That's the worst performance in 14 years. Last seen again at the GFC. Equity volatility really was exogenous external events that overwhelmed those fundamental factors. You touched on it, but an appreciation for fundamentals may be front and center in 2023. Is that correct?
I think fundamentals are always in vogue. So look, stocks down 20% in a year that inflation was in the high single digits. The real destruction of wealth was even more than $18 trillion, right? The actual purchasing power of your stocks. The other way to think about it is stocks down 20%, but actually, at least for the S&P 500, earnings grew about 10% last year. So the valuation D rate in stocks is about 30%. So again, starting place matters a lot. We're kind of back to average valuations in equities, but a 30% D rate. A lot of companies that grow faster, it was a terrible year for fast growth companies, right? And we actually talked about that in the Outlook last year. We said stay away from those money-losing high growth companies. That's going to be a dangerous place. A lot of those stocks are down 70, 80% this year. What's interesting though, they're down 70 or 80%, but they still grew kind of through that time period. So the valuation might be down 90% in some of those stocks. So again, the setup is a lot more favorable for both value and growth because the D rate has been really significant.
One of the things we talked about last Outlook was really focus on business resiliency and a company's ability to weather storms like we saw. Is that kind of the same message for 2023?
Absolutely. And one bullish aspect of stocks, even if we get some higher inflation, equities do tend to do better in an inflationary environment. We saw it this year. Many companies, a surprising number of companies, were able to pass on higher inflationary costs to the end consumer, and consumers sort of paid the higher bill. So there were a few notable cases where that didn't work, but in many cases, equities were relatively resilient to inflation from an earnings standpoint. So as we think about that multi-asset portfolio, that's another consideration for maintaining some equity exposure in that portfolio. If inflation, as Jeff is talking about, stays relatively high and we don't have as much expectation for capital appreciation from the fixed income side, own some stocks that can have pricing power.
So this is a perfect way to end our prepared questions and then go open it up to the audience. But I think I'll end it. It sounds like both of you are constructive for each asset class. And if I think back to what we've discussed, a 60-40 portfolio, when you talk about now you have bond yields at 5%, you have equity evaluations that are severely depressed off of the highs, it's actually not a terrible idea or a terrible. You're doing yourself a disservice if you've forgotten about that 60-40 portfolio. Is that the right way to think about it, Jeff?
I think it is, but again, I mean, as a portfolio manager, you always have to think about in terms of probabilities, right? So we're always asked what your base case is, and I absolutely have a base case, but I have a left tail and I have a right tail. And I think for both Ben and I, as we chat, right, the left tail risk, the potential deeper recession, the reality that the consumer is weakening, right? We are weakening as an economy. That's not questionable. But again, it's from an incredibly strong starting place, right? So while our base case remains relatively constructive from the setup here, given what already happened in 2022, in constructing a portfolio, I think the 60-40 portfolio is absolutely back. And it's absolutely back because traditionally you want a 60-40 portfolio because you have ballast. And you have that ability to have ballast. And that's both within the equity side as well as the fixed income side, right? There's actually still a lot of very high yielding, very interesting equity-like return opportunities within the world of fixed income. but those don't serve that ballast. And vice versa, as Ben talked about, the focus on potentially very defensive companies also exists in the world of equities. And so I think it's not as simple as just a pure 60 equity portfolio. I also think you have to think about how they interplay, and that's at the actual asset class or actual fundamental credit or company level. But the startup today or setup today is notably better than it has been.
Ben, you want anything to follow up on that, or shall we get into some client questions?
So Jeff and I probably agree too much on many things, but this is definitely one where I think the idea of a barbell makes a lot of sense. High quality fixed income has interesting yield today, and it's going to be resilient in the face of an economic slowdown. On the other side, there are interesting valuations in equities, especially international equities that we can talk about later. So kind of having that barbell, I think, gives you the ability to participate in a variety of environments that might not be exactly the base case.
Let's go into some client questions. And I have one here on economic data that I think is pertinent to actually this part of the conversation. Is there anything that you guys are looking at, whether it be positive or negative, in the context of judging recession that you're watching closely? Something that maybe is not on the radar of everybody or is?
I'll go back to what I said a little bit earlier. I think watching just consumer conditions in the labor market, to me, really is the most important. Because the question you have to get right into 2023 is where inflation goes and what is the Fed and other central banks' reaction to inflation, right? Central banks and the Fed in particular has told us they are playing for a slowdown in labor markets. We haven't seen it yet. We haven't seen it. And so a precondition to the Fed not continuing to march higher is getting that actual slowdown. Now it's probably on its way, but how deep and how far does that fall, right? So to me, it's all about the consumer. It's all about, in particularly, that lower income cohort of consumer, because they're already showing signs of weakness. So when do they potentially peak in terms of delinquencies, or do they continue to move higher? So watching remits as they come in within the world of securitized is probably my best recommendation of where to look. It's a monthly read. It comes in real time. And it provides a ton of insight into the strength of the consumer and the read through to potential inflationary conditions.
Ben, anything that you're looking at? Or
Sure. So credit spreads matter a lot. Global short rates matter a lot. I think that those are pretty common, but pay attention to those. The yield curve is inverted. That's a single metric, but it's actually a fairly powerful metric. So we'll be watching the shape of the yield curve. The other thing to be watching more from a market standpoint is we didn't have a huge contagion event in 2022, right? So it was a bad market, but we didn't have an EM sovereign defaulting. We didn't have European peripheral spreads blowing out. We didn't have a bank defaulting. So I think paying attention to some of those potential contagion risks, we were able to essentially pop a tech bubble, and a lot of those stocks have deflated a lot. Crypto was down a lot, so we were able to deflate some of those areas of excess in the market. But I think we have to keep our eyes on any areas of potential contagion spreading that would cause wider spread pain.
So certainly there is contagion in the energy market in Europe, and that's the next question. But it's really several factors are keeping Europe in a better position than they were last year. Milder temperatures, reduced heating demand, high storage rate. Ben, why don't you answer for us, is Europe okay for now with the ongoing energy crisis, or is there something to worry about?
So the energy crisis is not completely over, but that's a bit of a story of 6 to 9 months ago. So, gas prices in Europe are down 75% from the peak. So they had a huge spike. They're now back to roughly where they were before the invasion. So Europe has done a lot. Europe tends to move very slowly in these things. They've moved aggressively to diversify their energy, to increase their storage. So that isn't to say that we couldn't have another round of it, but I think that Europe is dramatically more insulated from the gas price than they were 1 year ago.
Thinking outside of the gas price, Jeff, there seems to be no end in sight to this conflict. Is the Russia-Ukraine saga, is that still kind of fairly insulated, or are there other things that we need to think about this year?
Yeah, I mean, one of the hardest to predict, but I think always needs to be on investors' radar is geopolitical risk has been relatively contained through 2022, right? And so we talk about, of course, the atrocities between Russia and Ukraine and the broader feed through of that. But I would really be focusing on US-China relations. And two world superpowers, right, are finding a way to peacefully coexist today, but I continue to expect the rhetoric to increase there. I don't think that's on investors' radar. I think it's an incredibly difficult environment to navigate. But to directly answer your question, I think we're in for the long haul between Russia and Ukraine, right? But it's not about Russia, Ukraine. It's really about East versus West, where Russia, as potentially a fading global superpower, has to address what their future is in the world relative to Europe, which is potentially realigning with the classic U.S. side of things.
Well, let's stick with the East. Ben, it seems like Xi Jinping, after China Party Congress, really was focused on scrapping zero COVID, really to hopefully inject some growth into their economy. Many believe that it's the reason for the supply chain disruptions, industrial production disruptions. Do you think that it's going to take more than just months to start an economic recovery in China?
So, Michael, youth unemployment in China hit 20%, and there was social unrest, and so I think that they realized they needed to relax the zero COVID policy. Sort of, no matter what the cost, they needed to get the economy going again. The downside, of course, is that we have a lot of cases of COVID, and that shuts the economy down in a different way from a quarantine standpoint. It's now shut down due to disease risk. So, that will eventually work its way through the economy, and we think that China will provide a growth impulse for the global economy this year. How much, we're not exactly sure. We do see they're stimulating, we do see they're opening, we do see they're turning a bit more pro-market with some of the technology companies. And as they stimulate, that's also good for commodity demand. So, China is an important growth impulse kind of always. And, this is a year that we hope, especially in the second half, that they can go a different direction from the rest of the developed world.
One question that we got in here was, and Ben, I'll go to you as a manager on one of our multi-asset income portfolios, really a demographic question. How does the significance of millions of baby boomers retiring annually impact the labor market picture going forward, and maybe some self-promotion on why income, particularly multi-asset income, is important in their portfolios?
Sure. So I think the labor force in the U.S. has a couple challenges. One is the baby boomers retiring. Two is lower workforce participation among younger people as well. And that's inflationary, and it tends to increase the need for investment income, right? So as you retire, you need more money to come from your investment. So we think that the ongoing structural demand for investments that can generate attractive current income, and as we saw in 2022, very importantly, the ability to grow that income over time, because inflation is a real thing, right? Whenever inflation was 1.5% or 2%, people didn't worry about it so much. When it's 7%, we worry about it a lot. So to have some investments in the portfolio that have the ability to pay today and grow over time, protect from inflation, that's a really powerful formula, especially for those aging investors to be considering. So dividend-paying stocks are the investment that has that characteristic. And what's interesting, dividend-paying stocks are attractively valued today, especially on a global basis.
Now, I want to add on just real quick. I mean, look, I think that question highlights that the predicament that the Federal Reserve finds itself in, right? It all comes down to labor. And again, I'll go back to what I said at the very beginning. This hasn't been one of the biggest economic experiments in history. It's been one of the biggest social experiments in history, right? Because what we find ourselves in today is perfectly encapsulated with that question. You do have a significant cohort of baby boomers that are potentially and likely never coming back to the labor market. Now, in a more traditional state of the world, what you would find is they're being replaced by the 18 to 24-year-old who's just entering the labor market. And that isn't happening. And it's not happening because of that incredibly strong starting place of the consumer, because of the ability of governments to fund themselves at 0%, the ability of corporations to fund themselves at 1%, 2%, 3%, in some cases 0% for even some companies in Europe. And for the consumer to fund themselves also at incredibly low interest rates, right? It's amazing to look back and think that we were able to borrow for 30 years to take out a loan to buy a home at 2.5% to 3% with complete optionality in our favor. That to me actually is a much more social backdrop that this question I think really gets into. It's such a difficult starting place for politics. And what we see today is a significant diversion between the left and the right in trying to answer some of these questions of the power of labor versus the power of capital.
Let me ask one last question before we wrap up. I'm curious to hear your thoughts on a particular asset class that you think is interesting, given all the market dynamics that we've discussed today. What are you interested in, and what looks appealing to you in this market context? Jeff, why don't you start?
Sure. Look, I would agree with Ben in some ways that the barbell portfolio actually does look very interesting. And what I mean by that, I think short duration asset-backed securities in particular are incredibly interesting. Yes, they're focused on the consumer. You have to have a hawk's eye on watching the trajectory of that consumer. But spreads remain relatively wide, and you're getting cash back on a regular basis, which means no matter what state of the world we move into, potentially you have the ability to put that cash to work in a more interesting environment. But despite the fact the starting place is incredibly, incredibly interesting. For a buy and hold investor, actually high yield looks pretty interesting. But what we worry about is the volatility, the ride. So we don't own a ton of it in our portfolios, but on a true, very long-term spectrum, yields stay are just tremendously more interesting than they have been in the past. That'd be my two places.
Ben?
So in addition to
income,
the left barbell from the ABS, I think that international equities look interesting today. So we've had a 15-year period of the S&P 500 outperforming international equities. Maybe that doesn't continue. A few arguments I would have: international including emerging markets. We can debate China's long-term growth potential and sort of how sustainable that economic model is. But in the near term, China has a cyclical bounce ahead of it. And so I think that the growth impulse coming from China is going to bleed into emerging markets. They have high trade linkages with China. So growth coming from China, I think, is going to be good for EM, and it's also going to be good for Europe. So European valuations are extraordinarily low, and we talked about how they've navigated this natural gas crisis, and we think that they're going to come out okay. So I would focus on international equities from a valuation standpoint, from a growth impulse standpoint, and then lastly from a currency standpoint. So the US dollar is about 13 to 15% above its long-term average, which means it looks kind of expensive versus international currencies. And as the US rate hike cycle ends, we think some of the impulse for money to be coming to the US abates, and that should be, over time, dollar bearish.
Ben, Jeff, thank you very much for your time. Really appreciate it. I'd like to say thank you to all of the listeners on the webcast today. We really appreciate. We know that there is a lot going on in markets, and we certainly appreciate you spending the time with us. Hopefully you found that informative. Two favors to ask. One is we have a survey that will be that you'll see at the conclusion of this webcast that we'd love for you to give your honest feedback. We're always trying to improve the quality of our content and what you all are looking for. I appreciate that everything you guys have done today in making this as interactive as it has been. The second is please take a look at our 2022 Outlook written piece, which is online and available on thornburg.com. From everybody at Thornburg here in Santa Fe, New Mexico, I'd like to say thank you. Again, speak to you soon, and looking forward to a prosperous 2023. Take care.